My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach. Context. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. We really needed that good but not great non-farm payroll number we got at 8:30 today. This market's got huge headwinds blowing from Washington. Everything from the trade wars to the inability to get a NAFTA replacement deal done with Mexico and Canada to the Federal Reserve's lack of sensitivity to the strong dollar. Put it all together, and the industrial economy just can't catch a break. And that's why the market exploded higher on that robust employment figure. Dow gaining 373 points, S&P soaring 1.42%, NASDAQ surging 1.40%. Although it didn't hurt, of course, as I talked about all week, that we were oversold. Look, I know the unemployment rate is down to 3.5%, lowest in nearly 50 years. But it has to do with the makeup of the economy. The manufacturing side of the ledger is just not doing that well. The weakness in manufacturing hiring gives Fed Chief Jay Powell all the ammo he needs to justify cutting the federal funds rate. That way, make it more in sync with the traditional curve of low short rates to higher long ones. Normally, you wouldn't expect the Fed to hit the accelerator with the jobless rate this low, but wages are still stagnant and there's no inflation to speak of. Basically, if Powell's asking himself, why not cut rates, the answer is, well, there's no reason not to. A rate cut could deliver some much-needed help to the ailing auto industry because car loans are priced off short-term rates, but also result in a weaker dollar, giving our manufacturers a big boost against their foreign competitors. Again, why should the Fed cut? Because right now, the 10-year Treasury is at 1.52. Federal funds rate, the overnight rate, is at 2. That's nuts. Powell should be taking his cue from longer-term interest rates here. That's what he should be doing, although he seems a bit oblivious to this very obvious signal, as are most of the commentators who come on TV who think that I'm wrong and he's wrong, and I agree with the president. Now, maybe if we weren't in this trade war with China, the Fed wouldn't need to cut. But that's not the world we live in. I think the president is right when he says the Fed funds rate is too high for no real reason. Remember, a year ago, the Fed tightened aggressively to get out ahead of potential inflation. They should do the same thing right now to get out ahead of potential slowdown. Be just with the same alacrity that they had the other way. That's what they should be doing. This matters because next week's game plan is all about China, both its economy and the trade talks with our government. We know the tariffs have hurt the Chinese economy, but we don't know how much. The Communist Party of China doesn't necessarily give you a full report. They do put out numbers, though. And on Monday, we'll see their Purchasing Managers Index, or PMI, reading. This is an important gauge of manufacturing. When our PMI disappointed earlier this week, well, it crushed our averages. Now, we don't know how much the Chinese fiddle with their own figures, but expect them to be accurate directionally, at least, meaning they're a good way to detect some trends, even if the absolute numbers, let's just call them dubious. I'm betting the Chinese PMI will be as bad as the Communist Party lets it be, which is probably not going to be so good. This reading is extra important because it sets the stage for the trade talks on Thursday, okay? Part of today's rally can be traced back to Larry Kudlow on another network. He's the president's chief economic advisor, who said that there might be some good things coming out of these negotiations. He just said it like that. The market exploded. Now, personally, after doing homework, I'm a little more circumspect. Sure, the Chinese might buy some commodities from us, show of good faith. But the president's over that. He wants real structural change. No more intellectual property theft. No more forced joint ventures. No more fentanyl flooding into this country illegally. And those aren't just the table. Look, those are table stakes before anything's get going here. I simply don't believe these substantive issues will be solved. China would rather suffer the tariffs than fundamentally restructure the economy. So come October 15th, I expect the U.S. will go ahead with its plan to raise tariffs on $250 billion for the Chinese goods from 25 to 30%. And frankly, after today's rally, I'm not so sure the market is ready for the next round of hikes. No, I think it's going to surprise to the negative. Beyond China, we have some important earnings next week. Domino's and Levi's report on Tuesday. Oh, these stocks have been suffering, right? Now, I think they've actually priced in disappointment, although they bounced back a little bit recently, and I wish they hadn't before they went to the quarters to report. I think Domino's has been hurt by all those third-party online delivery services. The CEO said the same thing on our show. And they can afford to lose fortunes building their businesses because they're playing with venture capital money. They don't report yet. The best thing Domino's had going for it versus the competition was its fantastic delivery network. That's no longer much of an advantage. However, yesterday, Wedbush, in a totally prescient report, said that they argued that much of the negativity is already baked into this stock. They also called into question whether the likes of Postmates, DoorDash can continue to afford losing money at the pace that they're losing it. Will this be the quarter where Domino's delivers? Let's hear what they have to say. I would love to be able to say, you know what, it's over, but I know that it's not. I own a restaurant and a bar, and I know it's not. But this stock has gotten cheaper. As for Levi's, the apparel business has gotten rough, especially jeans. That's the category very promotional. Again, though, the worst might be baked in. I don't think there's much downside to Levi's, but I have no idea what might drive it higher if the department stores that carry the merchandise are still struggling, and we know they are. Not much happens on Wednesday. It's the solemn Jewish holiday of Yom Kippur. Unless it's a day when analysts like to go light on anything market moving. Companies don't report. However, we do get mortgage application numbers, and these have been real standouts of late. And every time they've been good, they've moved the whole housing sector up, led by Lennar. Mortgage rates make housing stocks in fuego. Thursday, in addition to the trade talks, we also hear from Delta Airlines. If you're a frequent flyer, it's hard to believe that the airlines are in great shape. Nearly every flight's extremely full. But the industry's got some competitive route structures these days, and competition's always been the bane for the airlines. Once they start competing, prices come down, and that crushes margins. The transports in general have been an outrageously bad place to be. I don't expect Delta's quarter to change anyone's mind. Hormel also holds an analyst meeting on Thursday. This re-energized food company, best known for Spam, has done an amazing job of reinventing itself with the acquisition of Skippy's, Applegate Farms, and Justin's. It's been a long time since Hormel was just Spam. I think you can buy it ahead of the meeting. I arguably love a pullback, but this feels a lot like McCormick. Finally, on Friday, Wendy's has an incredibly important analyst meeting. I think they'll be able to explain why they're entering the ultra-competitive cutthroat breakfast business, something that was greeted with surprisingly negative trading. Wow, its stock got hammered. I bet the meeting moves the needle back. I'd be a buyer of Wendy's ahead of the analyst meeting. Bottom line, I know earnings season is kicked off already, but we're still in the slow dribble phase, as you can tell. The week after next will be insane. Better batten down the hatches and get ready for companies to adjust their numbers going into a new round of tariffs that, because of hopium, they're most likely unprepared for. Andrew in Michigan. Andrew!
Hey, Jim, what's going on? Thanks for taking my call.
Well, you know, I'm just focused on trying to figure out what's going on with the trade talks. How are you?
I'm good. Hey, so got a quick question for you. I bought some Lamb Research about a year ago, and it's just been on fire. It's up about 85%.
Right.
Just wondering what your thoughts are on selling, or if you think it's got more room to
Capital
go.
Trust we own a big slug of it. Why? Because when Tim Archer came in there, he exercised a tremendous amount of discipline, bought a huge amount of stock back, and the cycle is back. And the equipment spend cycle, and that means Lamb goes higher still. It's inexpensive, too. It's got a 2% yield. Bill in Illinois. Bill!
Hey, Jim.
Yeah.
I'm a first-time caller from the suburbs of Chicago.
Okay, love Chicago.
Hey, I wanted to know how to trade Altria over the next 4 weeks and through their third quarter earnings release. I expect earnings to be in line. However, not sure if they will take an impairment charge to their $12.8 billion investment in Juul now or wait till their auditors push it till later this year. The stock has lost $15 billion since the start of the year, and also the stock's lost $62 billion since in market cap since June.
Well, why would you want to own it? But what's the catalyst here? Are people going to start smoking again? I mean, I think that what they did with Juul, remember, I would rather have my kids drool than Juul. What they did with Juul was not right, and I'm trying to be diplomatic about it. No, I don't be diplomatic about it. They tried to hook a whole new generation on tobacco, and I don't have a reason that I want to own the stock. I got real growth stocks that don't kill anybody. I think that's a better theory on why you should invest. And am I angry about what happened with Juul? I watched Carl Quintanilla's documentary, and you bet I am. And I haven't stopped seething ever since it. FDA, you let us down, by the way. All right, Washington is a big headwind right now. So fasten up and get ready for companies to have to adjust to numbers lower if these talks don't work, and I don't think they will. On Made Money tonight, from cleaning to cooking and everything in between, Clorox has its hands on some of the world's biggest brands. But does it still have the growth to wipe up on Wall Street? Or could it become a stain on your portfolio? I'll mind the company after its analyst meeting. Then can Stitch Fix still dress to impress despite its drop following earnings? I'm sitting down with the CEO to see how to get this stock reignited. And the REITs have been roaring. Is it time to circle the wagons around an investment in the space? I'm going to give you my take. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.